All right. Thanks so much, Rob, for being here with me on this little video that we're doing. We had an event not too long ago, and it was an amazing event, but only a few people could make it. So I thought I'd throw this out to my whole network and just give a brief overview of what we were going on about that day, because I feel like it was very, very valuable information that the average person doesn't really know. So, anyways, Rob, if you don't mind introducing yourself, who you are, and what you do and how you're involved in real estate investing.
Yeah, for sure, Corey. Thanks a lot for, I guess, for us to get together again and be able to serve another whole large set of eyes here. It definitely was a great event. I appreciate you having me there. And yeah, so a little bit about me. My name's Rob Chopra. I am a real estate investor in the Niagara region. I've been investing in real estate now for, since 2012, but most importantly, taking it very seriously in 2018 and beyond to today. Um, I am a licensed mortgage agent there with the Finlay Mortgage Team out of Cambridge. I've been there for quite some time, and I have a mix kind of clients that I work with. I work for first time home buyers, second time home buyers, and investor focused home buyers as well. So something that I absolutely love to do. And I know today we're going to talk a little bit more about home equity lines of credit. So I'm really looking forward to it.
That's awesome. Thank you. Yeah, so the thing that gets me very excited about real estate and something I learned quite a few years ago was all the different creative financing options there are. Like the ones I love the most is the ones that the average person think are illegal because they sound too good to be true. So we're going to be hitting on one of those, and it's really we're going to be talking about like how to leverage your house to get more investment properties or whatever else you might need. So by doing this, you got to use it using what is called a HELOC. Can you explain what a HELOC is?
Yeah, absolutely. So a HELOC is short for home equity line of credit. And what a home equity line of credit actually is, it's secured against your principal property. What I mean by that is let's say you bought your property, could be last year, it could be 5 years ago, 10 years ago, whatever the case is, your property over time has actually increased in value. Okay. Although the interest rate environment today and from the peak to where we are today, there's a little bit of a drop. But really, for if you've been holding on to your property for some time, you've had what's called as a mortgage pay down on the property combined with appreciation on the property, which means that you'll have that equity standpoint within there. So what a home equity line of credit is actually that equity that's in the property that you can tap into and actually use as a line of credit. That line of credit specifically is can be used to purchase real estate. So from a high level looking in, that's a home equity line of credit.
Okay, so well, and so how would like the average person just get one?
Yeah, great question. So if you're looking to actually get a home equity line of credit on your property, we'd have to go through what's called as an appraisal, right? So let's use an example. If you bought your property for, let's say, $500,000 a couple of years ago, and in those 2 years you've paid down, let's say, $20,000 in balance of the principal, and now you have a mortgage of 480,000, hypothetically. If we get an appraisal on the property and the appraisal comes in at, let's say, 900,000. Okay, now you've got a difference between the 500 you bought it for and the $900,000 that it came in as an appraised value. What the banks will allow you to do is they will allow you, and obviously you have to qualify for this, right? This is based on ratio based lending. But what they will allow you to do is to go back up to the 80% loan to value of the appraised value of the property. So the example that we were using was buy at 500,000, or sorry, a mortgage amount of 500,000. It's now worth 900,000. 80% of 900,000 is 720, right? Because yeah, right. So 900 minus 180 equals 720,000. The difference now, because you've paid down, let's say, $20,000 on your mortgage, you're at 480. The difference between the 480 and the 720, that's the amount that you can actually get as a home equity line of credit. That's about $240,000. Really rough numbers, right? But going about getting one, Corey, is we're looking at getting an appraisal on the property. Whatever the appraised value is, you can take 80% of the appraised value minus the money that you owe on the property already. That delta, that's the amount that you can get for your home equity line of credit.
Okay, I think I have a pretty good question of I'm sure there's payments incurred with this.
Mhm. Absolutely. So another great question. So when you're looking at if you have your line of credit, let's say you get your HELOC, and we'll talk about a little bit later, we'll talk about how to actually like next steps to get one. But when you actually receive that home equity line of credit and it's in your bank account, if it's at a $0 balance, you actually don't pay any interest on that money, right? You haven't used any of that money, so you don't have to pay any interest on it. But once you actually utilize that money, you take some money off your home equity line of credit. Generally, and this is the caveat to this is it's very much amount dependent, okay, Corey? Like the lower the amount, you might see a little bit more of an interest rate. But as you get up into higher amounts, and banks will dictate what these amounts look like. But generally, the interest rate is prime plus a half percent to prime plus 1%. Okay, so if you borrow $100,000 off of your line of credit, off your home equity line of credit, secured, if you borrow $100,000, you're paying seven, let's use prime plus one, you're paying 7.7%. That's calculated per annum, right? So your per annum payment is $7,700. You would pay that monthly. Okay, so you divide that by 12 and you can kind of do the math of what your monthly payment would cost. All right, but that's how that payment perspective would work. And if it's prime plus a half a percent, then in that case it's 7.2%. You're looking at $7,200.
Okay, so actually you're talking about prime. Now, is this based on like a variable rate?
Yes. So the prime rate is based on the Bank of Canada's overnight rate. So whereas fixed rates, for example, are based off of the bond market, right? So as the Bank of Canada fluctuates their interest rates, so for context, we just recently had an announcement, right? And the Bank of Canada paused the rates, so they didn't increase them. So what happens is the variable rate uh, being decided off of the overnight rate. The overnight rate is at 4.5 currently. The banks decide what their prime rate is going to be from there. And right now with the banks, their prime lending rate is 6.7%. They borrow from the Bank of Canada, they lend it out, or sorry, yeah, let's just put it that way. They borrow the money at a lower rate and they lend it out at a higher rate, right?
So there's a chance that your payments could be cheaper. Like, would you say
They could
would
be,
you say
yeah.
in your opinion that it's pretty high right now? Uh,
Yeah, in my opinion, it's definitely high right now. I mean, from a macroeconomic standpoint, right? Like pre-COVID, if you look back at like March of 2020, maybe it was February of 2020, right in that area there, prime rate was actually at 3.95%. And this was pre-pandemic. As we went through the pandemic, things start to shut down. They stimulated the economy. They, due to that stimulation of the economy, because the inflation due to that stimulation goes up. The interest rates at that time had gone down. Now, because of where inflation is, they need to bring that down, and so therefore they increase the interest rates, and that's the environment that we're in today. Something that we were told a while ago that the rate increases would happen over time. They actually happened pretty much all in the same year of 2022, where we saw a huge increase in interest rates. So there's probably a lot of people that have mortgages that might even be watching this, that you might be sitting on a 2-3% type mortgage. You have it for a couple of years, but when you go back to renew, unless we go back to that same rate environment, we're not going to see those types of interest rates on your mortgage that you have currently right now. So it's really important to understand that come your renewal time, you are going to fluctuate. It's going to be a bit of a surprise, especially. But do I feel that it's currently high right now? Absolutely. Opinion based of where I think it's going to go. I think we're going to start to see some decreases here as we go through, not necessarily in 2023, but I do see, 2024 kind of going downward. Anything that I'm talking to my clients about right now, especially when it comes to interest rates, I'm talking a lot along the lines of like 2-year fixed rates, some 3-year fixed rates, and obviously, situation dependent, right? But the rates are really good on your owner occupied properties to take those. I know I talk about like fixed rates and variable rates here. The question specifically was, does a home equity line of credit work on the variable rate? Yes, it does. Even if you have a fixed rate mortgage, though, that doesn't mean that you can't get a home equity line of credit on your property. It's all going to depend on who the first position lender is, like who holds your mortgage currently right now. there's a lot of products that are out there, or shouldn't say a lot, but there are products out there with specific lenders that they will allow you to leave the first position in place and then put a home equity line of credit with that as well, but not have to restructure the first. So the good, and what I mean by the first is restructure the first position mortgage. So your options aren't out of line, right? That's something that I help my clients with. I'm always happy to answer those questions.
I'm not sure if I'm on the right track here, but I'll ask the question anyways. So let's just say someone wanted to renovate their basement to rent out. Is that what they would use? A home equity line of credit?
Yeah, that's definitely a good one, right? You could use your home equity line of credit to do renovations if you wanted to rent it out. I mean, essentially, Corey, you could use your home equity line of credit to go buy a car if you really wanted to, but that's really not why we're here today. And I don't advise you to do
I
that
think it's a good
or
idea.
anybody to do that, but the capital is at your disposal to kind of do what you want with it. It's important to keep in mind though that, you know, we want to be cognizant of the amount of debt that we have when it comes to having, a mortgage or maybe buying a second property, meaning it could be your first investment property, right? If you have a tremendous amount of consumer debt, it's not going to benefit you when it comes to buying that property because when you're buying your property and you're using a home equity line of credit, you actually have to debt service that, right? The same way that you would make an interest payment on it. So again, we'll go back to the example. If you take $100,000 off your home equity line of credit and it's at 7.2%, it's prime plus a half. Well, the way that we service it internally, currently right now, like we're amortizing that payment over 25 years, just like a mortgage, meaning we punch in the interest rate, we punch in the amount that you're utilizing towards your down payment of a second property, for example, or like an investment property. We're amortizing that over 25 years, and whatever that monthly payment turns out to be goes to your liabilities. So it helps a lot with the fact of bringing down your ratios, the lower liability that you have. So I don't suggest consumer spending on your home equity line of credit, but if you did want to use it to generate income off of it,
That's
it's definitely a great
Yeah, these
option.
are the things that sort of excite me. Um, yeah, it's because I'm just sort of thinking if someone were to want to rent out their basement and say they're going to get 1,100 bucks out of it, and they gotta
Yeah,
spend 40 grand maybe to finish it up. What could like
yeah,
that's not much of an interest rate. You're going to be still making money, right? And you're going
yeah.
to increase the value of your house as well over time because you have a legalized, finished, rentable basement unit on your house, almost making it a duplex in some cases. So like that to me, that's an like
Yeah,
I'm looking on a smaller scale, but then we're talking about larger properties, like actually get it. Do you actually have an example of someone like a simple example of someone like the first time buyer and they got a duplex from not a first time buyer but a first time uh, rental like that used their home equity line of credit to get a property?
Yeah, great point. So I currently have a client right now that we're doing that with. They're utilizing, their 20% down payment from their home equity line of credit. They're buying their first investment property. The HELOC was already actually in place, so they already had it. It was something that their bank offered to them. They didn't even know any different, right? Like their bank was just like, hey, do you want a home equity line of credit? Because that's something that can actually happen. But again, you don't know what you
Mm-hmm.
don't know, right? So the bank may not offer that to you. But what I was saying there is the full 20% down payment is actually coming from their home equity line of credit for this purchase. So for context, I mean, they're buying a 500. It is actually $500,000 that they're buying it, just over. It's 504. But my point, at $500,000, they're buying at, which would justify 80% loan to value mortgage, which is 400 grand. So they need 100,000. They're taking the $100,000 from their home equity line. I amortized it over 25 years to get the monthly payment on that by utilizing it, included that in their liabilities. They still fell below the ratio numbers that the bank wants to see. And now they're able to go buy that investment property. Their strategy that they have specifically for this, and something that I always do encourage people as well, is if you're using that money, it's borrowed money. It is the equity in your home, but again, it's still borrowed money. You do also want to have an exit strategy for that, right? Like if you're paying $7,000 a year on it, but it might be generating you
Mm-hmm.
$15,000 by using it. Okay, you get the delta, right? Like you make the 8,000 bucks in your pocket. That's great. You're making a good return on your money. But I also like to pay that back at some point in time. So usually what I'm looking at is when you're using that, you're looking for an opportunity for a value add where you can actually increase the value of the property by doing the renovations
This
to
is
it,
what I love.
right? So you might not just be taking the 100 grand, you might be taking 100 plus another 100 for the renovation. But when you go back to refinance the property after the cooling off period, you're there's a chance, and I never want to guarantee anything, right? Because we have to go through an appraisal, but there's a good chance you're going to get a large chunk of that capital back. You can pay off a large chunk of your home equity line of credit. Now you own a beautiful asset that's cash flowing, right? You have a little bit of money in it, but it's being serviced. The debt of the HELOC is being serviced by the cash flow in the property. It just becomes part of the expenses, right? So, and now you go do it again.
That's how
You know
many
what I
times
mean?
can you do this?
Well, it depends on how many Mercedes or how many BMWs you buy with your HELOC, right? I mean, it's ideally at the end of the day, as long as golden rule in financing, right? Keep your income high and your liabilities low. Utilize the debt that you have access to strategically and creatively, and you can keep scaling.
So you're saying keep your silly expenses low. Like when you start getting this, don't get a
Yeah,
crazy car. Instead,
yeah,
keep your Toyota Corolla, drive it around, get a couple more
yeah,
properties, and then down the line, those properties are going to pay for. We're getting ahead of ourselves here. Like this conversation gets me excited, and it
yeah, of
excites me
course.
like the thought of it, right? And of actually helping other people to understand this. Like this is a very exciting, like
Yeah.
simple thing that every investor that I know uses, right?
Well, you bring up a really good point, Corey, because you talk about like going to buy a few properties, okay? There's generally three, and I know I covered this at the live event, so thanks for bringing that up again because there's generally three ways that people get into their first investment property, or maybe it's even their first home, right? It's either gifted funds, which, we have to be cautious about gifted funds for rental properties, but let's talk about the home. It's either gifted from family, it's saved up money, or it's actually home equity lines of credit. These are generally the three ways that people will get into a property, whether it's owner occupied or whether it's a rental property. Right. And the caveat that I put on that is the gifted funds for rental properties. Right. Gifted funds can be used in current state for owner occupied properties, just conventionally, not for rental properties. But those top three things. So where you were going there with the fact of like rolling that and continuing to build out, and you buy a couple of more properties. I often have to remind people of remember the first one you bought? By the time you get to three, it might be time to go back and look at number one
Oh,
because that time now has
wait a
elapsed.
sec. So you're talking about leveraging that first rental property.
Exactly, right? So think about it from this perspective. Remember, we borrowed $100,000 to
Yeah.
buy this place. We might still be carrying that debt. We might be on property number three now. Maybe we're not carrying it. Who knows? But let's just hypothetically say we're still carrying property number one in a couple of years from now. We're already working on property number three. 3 years down the road, maybe even 2 years down the road, property number one will have a little bit of mortgage pay down. It'll also might have appreciated a little bit. Let's be conservative and call it 3% because the reality of 15 to 20 to 30% appreciation is just not
Right.
sustainable long term. It
Yep.
is what it is, right? But if we go back and now look at that and say, well, we got maybe another $30,000 in pay down on the mortgage, and it's appreciated by maybe another 50, or for this case, let's call it 70. Let's tap into it and let's go pay back that $100,000. So let's go refinance this property number
Oh, I
one
see what
again.
you're saying.
We'll go back,
Yes. I.
we'll go back, we'll pay off the home equity line of credit. Now we're already at number three over here. But because we paid this back now, that might actually help us now get to number four.
That's amazing.
Now we have access
So
to
see,
that debt
this is
again.
where having I spoke at our event, and what I spoke about was having a team in place. Now, the average mortgage broker won't know these things because they don't have investment properties. They might know it in theory, but are there a lot of hiccups they could come across that they don't know about? Like I don't think could you do this traditionally at a traditional bank?
Not necessarily. I mean, no no disrespect, right? I mean, there are bankers that are out there. You know, I had a phenomenal banker at BMO when I first got my corporate accounts a bunch of years ago, and that individual was so smart, and I was like, oh my gosh, like you know, I finally have somebody that understands what I do. He lasted 7 months. And that's one of the things to keep in mind too, right? Like as mortgage agents like myself is, you know, our business is forever evolving. Our clients are the reason why we exist. So for me, it's not like I walk in and I get a salary from my job because I don't. My success is dependent on the business that I do with my clients and I help them scale their portfolios and build. So I'm always going to be there to help strategize and put this
Sorry,
whole
let me
thing
let me
together.
rephrase sort of what I was saying is when you have a power team and you're getting into real estate investing, you have to surround yourself with real estate investing, mortgage brokers, real estate investing, uh, real estate agents, even contractors that invest themselves. You have to be able,
Yes. Okay,
for
my
this
misunderstanding.
reason of you know all the things that are possible because you've done them yourself, right? Like
Yeah.
what kind of
Yeah,
confidence would you have from
100%.
that? That would be amazing. Rather than a person who's doing
Oh,
it,
yeah.
they've heard about it and read about it, right? This is why you want to deal with people like you who actually invest in rental properties. It gives you like a head start, and
Yeah.
you miss on so many. What would it be? So many hurdles. You're missing so many mistakes because of your experience, because you live it yourself, right?
Yeah. Yeah, 100%. I mean that and I apologize. I kind of I went a different direction there. So the reality is at the end of the day is that you if you're trying to when you're trying to learn to skate, you're going to hire somebody that knows how to skate, right? You're not going to hire somebody that doesn't know how to skate, that's never done it before. So in this type of industry, whether it's your realtor of how to look for that property, you know, for you, for example, Corey, like you'll help your client find that property that you are know and are confident that this will work if you wanted to, let's say, convert it to 2 units, right? The basement size might be big enough, the ceiling heights might are high enough. You know how to basically show that this property is a great investment. Whereas for me on the financing side, I've been through this already. So I know how the hurdles work. I know the you know, the ropes or whatever that
Well,
saying
it's
is that you
even
have to
thinking
jump
ahead.
through to
It's
help
even
investors.
thinking ahead 10 steps
Yeah.
ahead of time. If you know what their goals are, you don't
Yeah.
want to cut your foot off. I don't know if that's the right expression. Too early
Yeah.
when you want to make bigger steps later on.
Yeah. And you know, look, for investors as well, I think it's important for your team, for us, to understand what your goals are, right? Like Corey, when you talk to a new client, you're asking what is their goal, like what direction they want to go in. When I jump on a first call with a client, that's one of my first questions. What are you trying to accomplish? If it's number of properties, that's a different story. Like, let's not focus on that. There's obviously a reason why you're trying to do this.
Right.
Let's dig a little bit deeper. Is it a dollar value? Is it an equity value? Is it a net worth position? Is it a cash flow position? Right? Just keep in mind that cash flow, especially because of the interest rate environment, can change. So we don't really want to focus on that, but it's really important. And so for guys and girls that have done that already and understand, now you put together a strategic plan. It's really hands off for the investor when you start to add guys like you and I or team members like you and I to their team. That's the most important factor of it. And I didn't realize this many years ago, like when I first started. You know, my first investment property was bought from a buddy of mine, from my dad's buddy, right? And my dad living in Nova Scotia and him living up here in Ontario. And he said, yeah, you got to talk to George. And God bless his soul, he's passed. My point is, I went to George.
Yeah.
George didn't know any better. George just
Exactly.
found me an investment property.
Exactly.
I went to the bank,
Yeah.
right? I got my financing at the bank.
What?
I didn't know any better. So
Yeah,
you don't know
and my
what you don't
first
know.
story, I did my research. I read Rich Dad Poor Dad, and they explained about the power team. So I ended up having a coach, and that coach pointed me to how to find someone. I ended up finding someone awesome, and he found me a property that of the parameters I wanted. He knew the numbers, he knew it cash flowed. He told me he knew
Yeah.
what I wanted, and he was able to deliver quickly. So, all right, well, let's get back on
Yeah.
track here. with the HELOC.
Yeah. Doesn't take for us less long to get off track, but
So
that's okay.
this sounds so amazing, and it's almost sounds too good to be true. But surely there's got to be disadvantages. Like I want to know what when I do things, I want to know what could go wrong, only for the reason that I can prepare properly for that.
That's a great question, Corey. Like, obviously, with anything, there comes risk, right? But there's also advantages on the other side. So let's talk about a couple of the risks, like you said. So, number one is your real estate is never guaranteed, right? If you buy a property today and it's 500 grand, and your expectation of it when you're finished is going to be 750,000, and the market happens like it did to us, and it's actually only 650,000 by the time you're done, you're going to have what you project from what you projected at the very beginning to put into that property and what you projected to take out is going to be less now because of the valuation of the property. So you might have more money tied into that property than you originally wanted to. You need to service that debt. There's a golden rule with that though, right? And what that is the more money you leave in a property, the higher your cash flow is going to be anyway because your debt is now reduced. So it's not such a bad thing, right? Normal, typical real estate investing over time it's over time. That's literally the answer. It's over time. It does a thing, right? So that's one of the risks to be cognizant of. The other ones, okay. Another one of the risks that you could think about, Corey, is actually the interest rate hikes, right? Like we talked about prime lending rate today being at 6.7%. If prime goes up, let's call it a 0.5%, we're at 7.2. Your money now just got a little bit more expensive. And that can happen at any time while you're in a project. As an agent on the financing side of things, when I have a client that's utilizing their home equity line of credit to buy a property, we're already forecasting that. We're forecasting, especially what's happened in the last, 16 months. We're forecasting what happens if a rate increase happens. What does that look like for our payments? Is our property still going to be able to sustain it? That we're at a positive cash flow on the property still, even after the money we put in. If it goes absolutely astronomical and wild and the rates just go up and up and up and up and up, and I think we're done with that. That's personal opinion. But if they continue to do that, well, there's no control over that. But it's important to note that the risk still exists, that if the interest rates do happen to go up, your payment will go up. However, the flip side to that is, what if the interest rates go down? Now your payment is less, and now your cash flow is actually higher on the property because your
Well,
debt
and that's what I
servicing is
sort of
lower.
feel now. Like I notice a lot of investors jumping in now when other people aren't because they know if a property kind of makes sense now, it's going to really make sense later on. So they're willing if it's going to, I heard a conversation today about a bit of negative cash flow, which is your rental income minus your expenses. So if it's negative, say $200 a month, but the big picture of that, even if it stayed like that, you're still making a ton of money over the long haul. You're still well above what you should.
Yeah. Yeah, and I don't think it's for everybody. Like the negative cash flow perspective, let's put that into context right now, right? I have a client that I'm working on a file for, and they actually have, a multitude of properties, right? They have a handful of properties, and due to the rising interest rates, the cash flow has gone down. And therefore some of the properties aren't actually cash flowing anymore. Now, very savvy investor by this point, right? Portfolio is nice and large, but very savvy by this point. So they've already have reserves that are set in place for a time like this, right? But it's important to note that, real estate over time, again, right? It's time in the market. My suggestion at all times is anybody using a home equity line of credit is to, have a really good idea of what the budget looks like, and then go follow through with the project, follow through with the steps. Once you're at that completion phase and you know what your appraisal might look like upon the completion of the property, then readjust and go look for that next one, right? I think you would agree with that, because if you get into a position where, in a volatile environment, you're just like buy, 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 buy. Interest rates go up by
Well, I
half a
think
percent,
that's
then what
when,
happens?
like our friend Mark Lawfer likes to say, is when the sea goes out, you see who's been swimming naked, right? Yeah,
Yeah, the pants come down, right?
yeah,
You see who's got no pants on. Yeah. And we don't want anybody in that position, right? And it's kind of I'll share this with those that are watching. I know it's going to go out to everybody, but the reason that I got into mortgages in the first place was not just because I love the financing space and it was an additional layer of what I just enjoyed doing every day in real estate. A lot of it was for the educational factor of things, right? I feel that, all due respect to everybody, but I feel that, new clients, new investors are sometimes not given all the tools that they need. And it's important for them to understand, like right from the macroeconomic level of what they're actually getting involved in. Before you go leverage debt, just because you can leverage it to go buy something, it's important to understand what an interest rate is, right? And I found that with those conversations that I've been having with those clients, I'm also able to have that with their realtors like yourself, right? To say, hey, look, this is where the number makes sense for them based on where they want to go and what their goals are longer term. Corey, let's look in this range. This is what makes sense. So we set out a strategic plan for them the same way that you do, right? That's one of the biggest reasons I got into mortgages was, just from an education standpoint. There's a
I
lot to
love that
share. People
because
need
that's
to
pretty
know.
much the same reason I became an agent. Is I remember when I got my first
Yeah,
properties, there wasn't a lot of, I sort of needed my hand held a little bit, right? And even though it still went okay, but I made a lot of mistakes. And if I had that person with
yeah,
me to help me out along the way, it would have been so much better actually, right? So that's similar
yeah.
reason.
So yeah, let's talk about a couple of the advantages. So number one is let's talk about the potential returns, right? When you're looking at real estate, when you talk about return on investment, you're talking about mortgage paydown, appreciation, and cash flow. Of only one of those, one of which is guaranteed, and that's your mortgage paydown. And that's under the assumption that you're going to pay your mortgage from the income that comes in. When you add all three of those together, you should be getting much more than what that cost of
Most
that
definitely.
home equity line of credit is. The cost of the equity line of credit, again, let's just use prime plus one, is 7.7. You should be getting much higher, right? Even if we used a conservative 3% appreciation, or we used a 20% return on investment or 15% overall return on investment. I mean, you've already doubled your money. So when I look at leveraging that money, that capital, to buy something that's going to give me a much higher return, that's definitely a potential advantage, right? Another thing could be is access to larger sums of capital. So if go back to the original equation of $500,000 mortgage versus $900,000 of appraisal, we've got a large sum of money that's in there that we can get a home equity line of credit. How long would it take you to save up 250
Yeah.
grand? Probably a long time. Some people will never save 250. That's the reality of it. Inflation's high, cost of goods, it is what it is. Might take you a long time. So why not leverage that, right? Give you access to a larger sum of money, right? That'll help you kind of get through everything else. Another thing could be is tax advantages. Now, total disclaimer, not an accountant, not a lawyer. However, for investment purposes, if you're using your home equity line of credit towards purchasing an investment property, speak to your accountant about this, but you may be able to utilize write off that interest against the property,
Maybe
against your
having
taxes.
an
Okay.
investor
So
accountant,
100%.
another power
I
team.
highly advise that. And we are
Yeah.
in tax season. We're definitely in tax season, but that would be another one. And I would say, really, in my opinion, those are
Beautiful.
pretty
All
much the
right, what
top
do we
three.
do next? What are our next steps?
Yeah, yeah, great question, man. Okay, so if you are looking to get into something like this and you want to explore if you have that capability that you can get a home equity line of credit, a couple of ways that you can get started. I am a mortgage agent. I'm always happy to assist with anything like that. If you'd like to go directly to your bank and have that discussion with them, that is also an option for you. Just understand, though, that the number one thing you have to do is you have to go through an appraisal, the appraisal of the property. And I use that example at the very beginning, you get an appraisal at the property, you determine what that delta is in there between, and that's where we're able to get that home equity line in place. So next steps would be to speak to a financing professional, whoever that is. And like I said, Corey, I'm always here to serve any of your clients or anybody that's interested. But That would definitely be the next steps. Once you get that in there, then we build out your plan. We'll already be working on your plan. If you're working with me, we're already working on your plan prior to even getting that HELOC, because once we have the appraisal and we know the approval is in place for the home equity line of credit, now we can start to build that strategic plan of how to get into that first investment property. And then, we're off to the
Awesome. So
races
this
with
is
the
such
purchase.
it was such a good conversation. Like I got so much out of it, stuff I forgot, right? And stuff I think during the event I probably wasn't
Yeah.
listening because I felt like I heard it for the first time. Can
Yeah.
you let everybody know how to get a hold of you?
Cool. Yeah. So the best way to get a hold of me, Corey, yeah, absolutely. You can catch me on Instagram at rob.chopra. Feel free to send me a DM there. By phone, 289-241-7959. Or you can reach me at rob at the finlaymortgageteam.com. Rob at the finlaymortgageteam.ca. On any of those platforms, I'll be happy
Awesome, man. This has
to
been so
assist for
wicked.
sure.
Thank you so much for this, and it's been awesome.
Yeah. Corey, I appreciate you having me. Thanks a lot. Glad to be of service.